John, thank you for joining us today. This is going to be, as I said, recorded for our Eagle Connect program. And we will have this on YouTube and available to our students. We share it with prospective students, current students, and alumni members and community. And so we're looking forward to hearing a little bit about what you have to do. The purpose of how we got the Eagle Connect started was to provide students, our Eagles, connections to the professionals that are out there doing the work that they're interested in pursuing. And so anything that you can think of around the world of advice that you'd like to give, that you would have given yourself back in the day, or that you have learned through your work, will be very valuable to the students as you share your experiences with them today.
Great.
Can I pick it up there, Mackenzie? Thanks a lot, John. The students know that you and I go way back. This is a great group that I have in class, basic finance, principles of finance class this semester. We've covered, to this point, some basic big picture things regarding markets and the role of finance, and even a little bit about stocks and bonds. So if you don't mind, could you briefly tell us what you do, who do you work for, what kind of company do you work for now, what does that company do, and then I'll back it down to some of your early career decisions.
Okay, great. So thanks, Mike. So my name is John Fox. I'm here in Boston. I work for a firm called GW&K Investment Management, and we basically manage client assets. I am the co-head of fixed income, which means I'm in charge of the municipal bonds and the taxable bonds, corporates and treasuries, basically the two bond departments that we have here. But functionally, I am a portfolio manager. So I am sort of the chief strategist for how we manage our municipal bond portfolio. So we manage about almost 50 billion, 49 billion in assets. About 33 billion of that is in municipal bonds. And so I spend the bulk of my time managing those assets. Also, we're not a mutual fund. We have mutual funds, but for the most part, we do separately managed accounts for high net worth individuals. That's our client base. So that's in a nutshell what I do.
That's good, John. And I've been reinforcing to the students that the language of finance that you and I have lived it for a little while. It gets kind of ingrained in us, but there's a lot of terms that are interchangeable. So you use the word fixed income, and I don't know that we've used that in class, but that means the very same thing as like a bond or debt, or somebody borrowing money, a company, or in your case, a municipality, raising money. And the fixed income component is the interest payment that we've talked about in terms of our vocabulary so far. So that's a great intro, John. Thank you. Let me take it all the way back to, we did go to college together, full disclosure. The students have grown to love Boston College in many ways, forced upon them. So how did you navigate your early career? These students are juniors and seniors sitting here. What kind of decisions did you make early on to recognize you wanted to be on a business track and then maybe a more finance track?
Right. So I'm unusual in that I've been working at my current job, my current firm, since I graduated college. So I graduated in May of 1990. I started working here in September of 1990, and I just had my 30-year anniversary. So that's very unusual in this day and age. So, but going back to how I got here in the first place, I kind of just lucked into it for the most part. I was an economics major at BC, but I knew nothing about the market. I mean, I knew far less than what you're being taught in this class. I knew that there was a stock market, and I knew that there was such things as interest rates, but I mostly thought of interest rates as what money in the bank was paying me. You remember, so when we were back in college, it was the mid 80s. And in high school, the early 80s, think about back to the Reagan era when interest rates were much, much higher than they are today. So, if you put money, I remember we were saving for college and we would put money in the bank and we could get 10 or 11 or 12% interest on that money I was saving for college. And that was a big deal. Those days are gone. I mean, if you guys, anybody has any money in a bank knows now you get next to nothing on that. So I understood that. And I understood that there was a thing called the stock market. And that's about it. So when I went to join, I knew I wanted to, work in Boston. And Boston is sort of the asset management capital of the United States. A lot of buy-side firms, a lot of the mutual funds are here. Fidelity is here. So I just put my resume out to a number of different firms, and the firm that I've worked for, I did through the Career Center, and I never heard of it. I just, I just put out my resume. I got an interview, and it was for a very low-level job in the firm. It was an operational job. Obviously, they're not going to give a good job to a senior in college. I didn't know anything. I certainly didn't understand the mechanics of what I was doing. So my job was to reconcile bank statements versus the statements we had here. So we manage money for clients, so we had to keep track of that. But the clients kept their money in a bank. And my job when I came here was to make sure that our files matched the bank's files. And it turned out to be a great, it was very low level, it was very low money. But what I learned was the language of the bond market. I learned the language of bonds. I learned what a coupon was. I learned what a yield was, yield to maturity, a yield to call. I learned the dollar price. I learned what accrued interest was. I never heard of any of these things when I was in college. I never took a class with bonds. But if there's one thing you should know is this is not rocket science. We are not splitting the atom here. This is, for the most part, 8th grade math. A little bit of statistics is a good, it'd be nice to have a good background in statistics, but that's about it for as far as advanced math goes. And so really when I got here, I just tried to absorb as much as I could. And when anybody needed help at any part of the firm, I said, I don't know anything, but I'm a quick learner. I can figure it out. And I just tried to help. And within 6 or 8 months, there was an opening on the bond trading desk, the municipal bond trading desk. I didn't, like I said, I didn't know what a bond was. I certainly didn't know what a municipal bond was. So I put my hand up for that. I did a very good job in what they had initially asked me to do. So they let me do that. And from there, I just kind of worked my way up the ladder in 1995. So within 5 years, I was a portfolio manager, managing bonds. As far as the tricks of the trade, well, I didn't really have any, except to be a hard worker and to absorb and learn the lingo of investing. And that's, to me, that's the most important thing. I mean, and if you like it, you'll learn it. If you don't like it, well, you're probably gonna have a hard time learning the terms because they're not gonna mean much to you.
That's good, John. Let me just pick up on one thing you said. Back when we were in school, I would say, even at a big school like Boston College, we didn't have the kind of career service guidance that these students have available to them here that McKinsey has built. So that's a commercial for McKinsey's group, and also just a message to the students that you should take advantage of that in every way possible. So, John, I wanted to also ask you, what sort of skills early on did you recognize were going to be important that helped you kind of move up? You mentioned just plain old hard work. What about like stuff like sharpening your math skills, financial statement analysis in your career and in your field? What stuff was important?
Okay, so the number one thing in the investment world, when at my firm, when I was looking to move up, obviously having a grasp of math is good, but like I said, it's low level math. I mean, this is stuff you can figure out pretty easily. But one of the things to move ahead in the investment world is you really need credibility. And other than doing what people ask you to do at your firm, it's very difficult to project that you know things if people don't give you a chance. So the number one thing that you would want to do in our industry, in the investment industry, is to get the CFA, okay, the Chartered Financial Analyst exam. It's it's offered in 3 parts: CFA level 1, level 2, and level 3. You take it. It used to be you take it once a year. Now I think they offer it twice a year. At least they offer level 1 twice a year. And at my firm, that was a huge deal. Okay, everybody knew who was taking the CFA. Okay, and it was if you failed the CFA, it was a big deal because other people were taking it at the same time you were taking it. And it, the CFA just goes through and it teaches you all about. It's basically like going back to school. Security analysis, discounting cash flows, all sort of invest. A lot of it is ethics is part of the things, but it's all geared towards analysis in the investment world. And as I passed those levels, if I passed level 1, it was like, oh, okay, this guy, not only is he smart enough, but he's motivated to do this because there are difficult exams. Mostly not because the topics are all that, difficult. It's more that it's very comprehensive. But I always tell when I mentor kids in my own firm, a lot of them want to show that credibility too, but they want to go to business school, and business school is great too, and it gives you a nice broad, like to get their MBA, and that's nice, but it's not enough in our industry. In our industry, you really need to have the CFA to get any sort of credibility. So I would encourage anybody, even in college, to start thinking about the CFA. The level 1 exam. Mike, I think you even took it when you were in college, or if you're not, you took it maybe. You were the first person who even talked to me about it. You were the one who got me onto that. But again, when I got to my firm, it was pretty clear that's what you needed to do. So in the investment world, especially on the bond side, taking that, but even on the equity side, it's very difficult these days to move up or to get ahead in our industry or to learn more unless you have the CFA. It's almost like a prerequisite.
Yeah, and there's ways that universities can now partner with the CFA, John, that I've done some work on, and we may have a link to that more directly. So I wanted to pick up on one thing, John. You do, I know, have a role at your firm with the younger analysts and people that start coming into the firm. What kind of things are they good at that you would advise the students to know as they want to become good candidates when they go walk in the door at various firms?
For me, and when we interview people, one of the questions I always say is, describe a process that you were handed that you improved. Okay, so and when you join any firm, you're going to inherit the corporate thinking that came before you, and so part of that is like, this is how we do whatever job you're going to get. This is not just in the investment world. This applies no matter where you go. This is how we do it here, and that's fine. As you have to respect that when you join a firm. You want to do what they tell you to do, and you want to work on a process that they tell you. But all processes can be improved. And to me, unless somebody has demonstrated the ability to take a process that they were handed, find the flaws in it, and fix it, and improve it, make it more efficient so that you can take on more work, that you can make the company more efficient. That's really what you need to do. And so a lot of times we'll ask these questions to people in interviews. Just like I said, describe a process that you took and you improved it. And you wouldn't believe all the wheeze we get. All of a sudden, people turn into they become very modest. Well, I worked in a group, and we did this, and we did that, and we did the other thing. And I don't care what the group did. All I care about is, what did you do? What did you do? How do you think? How did you tackle a problem? that you were handed? What specifically did you do? And I think as you navigate your career, you think about what you want to do. That's you need to start thinking about yourself. And it's not a selfish thing. It's more it's a clarity thing. You want to have clarity. What do I like? What am I good at? What do I gravitate towards? Because there are so many different things that you can, so many things in our world where you can express yourself and express or get growth. Like, you know, in my industry, in my company alone, investment management, there's so many things. If you know, we have 160 people that work at our firm now. But if you joined our firm and in the investment process, you could work in the IT department, right? Helping us with our technology. You could work in marketing. You could work in sales. You could work in client service, where you're actually the person who talks to our client and tells them what we're doing. You could be on the investment side. You could come into the municipal bond department. But when you were in the municipal bond department, you could be a portfolio manager. You could be a trader. You could be a credit analyst. There are a number of different things that you can do. And then you can be on the operational side. You could, you know, which is where a lot of lower level kids start, you know, just making sure that when we do a trade, it settles at the bank, something as routine as that. So there are a lot of different things you can do, but you do have to, you want to figure out what it is you like, and again, make improvements. And to me, that's life in general, right? You always want to grow. You want to take risks. You want to get out of your comfort zone. You want to ask a lot of questions. Find mentors. Whoever you could find, even if it's a peer mentor, somebody that you can either vent to or ask questions. But you want to be in a position where you're comfortable with your own knowledge of something, so that you can ask those questions and move up. Like I said, nothing's that difficult, but you know, you do want to keep moving along in that direction, if that makes sense.
That's a great answer, John. Thank you. Let me ask one more question, then I'll open it up to some questions from the students. So, John, I do know that you have an MBA because I know you, and I think you even did that while you were working. So many of these students have thought about maybe graduate school as they, think about their careers, whether in business or otherwise. Is that something you'd recommend generally?
Yes, I would. So I just spoke about the CFA, and I think the CFA is critical to getting a credibility that you literally can't get anywhere else. It's the quickest way to credibility. And you need it in our firm. But an MBA is great for other parts of what I do. So I'm also a partner at the firm, and I'm on the management committee, one of 7 people on our management committee that actually runs the firm. So I'm part of a team that tries to navigate the investment world, and what is our company doing, and what are we good at, what are markets we should be entering, what are markets we should be exiting. And I think having an MBA really helps you frame those decisions and move forward. The MBA is great, and how they have the case study method, where you really take a look at different case studies, and you're given a problem, and there's no set answer, and it encourages group, we call them group projects here, but at my firm, it's corporate thinking. You're gonna make a much better decision when you're in a group setting than you are on your own, and because you're going to learn from other people, and they're going to have different perspectives, and they're going to challenge you on some of your own biases or your own assumptions or your own premises, and say, oh yeah, I didn't think of that. Okay, we should, right. Well, I think of, and business school to me fosters that incredibly well. There's some, I would say that part of my career where I'm thinking much less about the portfolios and the investing and more about the business, I lean very heavily on a lot of the principles I learned in getting my MBA, which by the way, I did not want to get. It took me forever. Like you said, I did do it at night here. I also went to Boston University of all places, which was like, the only reason I went there is because it was a quick commute from where from where our company is here. But no, it was a great experience, and it was very valuable in my career in helping me navigate things and frame things to think about.
That's good. Yeah, the students may not know, John, Boston University is a rival inferior school to Boston College. Yeah.
Far inferior, yeah.
That's going to be on the midterm. All right. Who has a question? I think Mackenzie, did you?
I wanted to follow up. So here at Midway, we have a program where our students can do a 4+1. So you get their 4-year bachelor's degree and then start taking courses to their MBA as undergraduate students and finish their MBA in 1 year. Which I think is a really great benefit that you all have. That's really wonderful. Can you give us some encouragement? Tying that to one of my other questions is, as a young professional with a head full of knowledge and a desire to grow, how can they use their knowledge, skills, abilities to find mentors and to capitalize on a mentoring relationship?
Mike, can you help me with the last part of that?
Yeah. So Mackenzie was talking about we have a program at the university which is called 4+1. And it enables the students to start taking, correct me if I'm wrong, Mackenzie, graduate level programs while they're, I think, juniors and seniors, and then finish off a graduate program in a year. And so that, I think you're asking how John feels about that track, number one. And also related to that, Mackenzie's question was regarding you mentioned mentors and how important those are. How do you find one of those? And what's a good strategy to network towards one of those? Is that close to what you said? Yeah.
So I do think obviously doing the graduate track is a great way to go. I don't think it's necessary, but I think it's excellent, and it's, especially if you haven't had a lot of exposure to the business world, it's a good, it gives you good, especially the peers you're around. You're going to learn about different aspects of the world that you can go into. So I think that's a good idea. As far as the mentoring goes, I think that's critical. I think back to the doors that I walked through in my career. I made a few decisions, a few very important ones, and most of the ones I made that were that helped me the most in my career were very difficult doors to walk through. And I was very nervous doing it. And I don't think I would have been able to do it on my own. And so that's where I think a mentor is invaluable. And it can come from anywhere. A mentor could be, like I said, it could be a peer. Ideally, it's somebody who's been there before you. So my mentor here was a guy named Tom Powers, who's now our co-head, our co-president. Back then, he was our head of sales and marketing, and I'd actually been working here 5 years before he even joined, or I guess it was 3 years before he joined. And he was 3 years ahead of me, but he knew the outside world so much better than I did. I knew municipal bonds. By that time in my career, I was kind of known as the guy who does all the investing, and at a pretty young age, I'd really dove into that. So I wanted to make myself valuable at something, but there's so much I didn't know, and that's what he was there for. He was there for me to when I was frustrated about something. Should I say this? Should I confront this person, or should I not? When we sold our firm in 2001. That was a big moment in my career where I had to actually go to our CEO and talk about my future. And it's something I really wasn't comfortable doing. But I talked to Tom, we talked our way through it, gave me a lot of good tips. And I felt so much, I felt like I wasn't doing it by myself. I felt I wasn't alone doing this. So, you know, some of this stuff is very subtle. Some of it is obvious. Some of the, you know, some of these doors I walked through were obvious, but other things are much subtler. But I think you have to have that all the time. You may not even know somebody as a mentor. They may just be a good friend. But you know, you want to be able to, you need some outlet just for yourself to make sense of, what am I doing? Like, what am I doing? Where am I going? Like, you should always be thinking about that. Even at this age, even where you are in school, like where do I want to, even if you don't know, it's valuable to say, I don't know. These are things I like, but I don't know this area. I'm a little bit worried about this. Oh, fine. I mean, look around. There's not that many smart people in the world. You're gonna have no trouble navigating where you want to go. But if you're worried about it, you keep it to yourself, you don't express it, that's really the only way you're going to get held back. So even somebody who's not there, it doesn't have to be somebody with sage advice, because really it's more about you coming out of yourself. You know, come out of yourself and say, this is what I'm worried about. This is what I'm thinking. This is, you know, it's not that hard, you know? So I would really encourage, I frame it as find a mentor, but what I really mean is be comfortable with yourself, express what you're thinking, be realistic, and, you know, just follow a course, follow your instincts. Good things will happen.
Yeah, that's another great answer, John. And I would just add, that doesn't end when you become, 2 years out of college, right? Like we still do that in many
Absolutely.
ways, right? And bouncing ideas about the market off of us and our other close friends and professional associations. So yeah, that's important, really important to remember.
In fact, Mike, I would just to add, some of my mentors now work for me. I've been in business less than 5 years. They're not even in my department, but I've recognized that they're very good at a skill like Excel. Somebody's great at a pivot table in Excel, and I'm like, I need to get more efficient. And I'll talk to that person about, you know, but I have to first acknowledge that I'm not very good at this, but I'm a smart person. I can figure it out, but I do need help. And so, you know, you're going to somebody who can help you, even if it's somebody, you know, who's very green in other areas. So just keep that in mind. You should always be learning.
Yeah, excellent takeaway. So we have some questions from the chat, but let's see if who has a question live. Anybody have one yet? No, you're good. Okay, so we have a couple on the chat. Which you know them, Mackenzie? Maybe we're gonna just have Mackenzie read those to you, John.
Okay. One of the questions in right now is, how has COVID changed your daily work and also across your firm in general?
So that's a great question. So I'll stick to, you know, my role as a portfolio manager. So it's a long answer. I'll try to keep it brief. We basically manage money for high net worth individuals. So somebody has $500,000. They want to invest it in municipal bonds. Okay. Why do they want to invest it in municipal bonds? Well, the reason they want to invest in municipal bonds is because bonds are a very stable asset class. Okay. Provides predictable returns. And in municipal bonds, the very, very high quality. You know, you're lending money to states and cities and towns, and the default rate on these are infinitesimal. Okay. And most importantly for municipals, they're exempt from taxes. So that's why high net worth individuals want to buy them, because they want to get the income, but they don't have to pay any taxes on it. If they owned a treasury bond, they would have to pay federal income tax on the interest that they earned from the treasury. So my job is to say, okay, we've got this money from the client. Okay, what do we buy? The municipal bond market is a $4 trillion market. Okay, there's 50,000 different issuers of municipal bonds. There's a million different CUSIPs. So it is tremendously fragmented. It's much different than the stock market. There's not even 5,000, I don't think there's even 5,000 publicly traded companies in the US. I think the Wilshire 5000 only has about 3,500 stocks in it. So it's a much different world in the municipal bond market, in that it's very fragmented, and it's dominated by retail investors, right? Most people who buy municipal bonds are individuals, whereas the other asset classes like equities, stocks, other types of bonds are, the people who buy those are much more institutional, okay? Big pension plans, but a pension plan is not going to buy a municipal bond because pension plans don't pay taxes anyway, so they wouldn't get any benefit from the tax exemption. So, you know, that's why our business has done as well as it has, because we've catered to individual clients. So what my job is as a portfolio manager, you think about how we're going to manage. Well, there's three ways of doing it. First thing you have to do is make sure if you do buy a bond, if you do, you know, from say the state of Kentucky or the Commonwealth of Kentucky, you have to make sure that the credit is sound. So you have credit analysts they're in our department, where their sole job is to make sure the credit quality of what we're buying is sound, is solid, is going to remain solid for our clients, so we don't have any defaults. Okay. Another part of what we do is trading. So we have traders on our desk, and their job is not to do any of that kind of analysis. It's simply to execute trades. It's to pick up the phone, call a broker. Somebody says, oh, there's 10 million bonds out for a bid. Our traders are the ones that make those bids. They actually bid on the bonds. And then the portfolio manager, what I do is, my job is to make sure all that works right. I'm the one who's setting strategy. Should we own long-term bonds? Should we own short-term bonds? Should we take more risk and buy lower rated bonds that are a little bit shaky on the credit side? Or should we start buying bonds that are, you know, very, very solid credit? There's a lot of, you know, it can get complicated. I'm not going to get into the complexities of it. But as a portfolio manager, you're sort of navigating the tension between the traders and the credit analysts. Credit analysts may like a bond, one bond over another one, but the traders may say, well, you know, they may have their own ideas on what they want to buy. We all have to come together, and as a portfolio manager, I sort of have, you know, the final say on that. So most of my day is spent following the markets. Okay, so just in general, what's going on in the world, which is a great part of my job, because what's going on in the world is changing all the time. It's such a dynamic market. And then it's also working with all the different people in my departments to make sure we execute a bond strategy on behalf of our clients. It's really as simple as that. Clients give us money to invest, and we have to figure out what's the best way to invest it. You know, so I mean, if the analogy would be on the stock picker side, right? You know, you put your money into a mutual fund, you have a mutual fund manager. A mutual fund manager is going to pick whatever, 50 or 100 different stocks that he or she thinks may go up or go down. It's the same kind of deal on our side, but the mechanics of what we're investing in are just a little bit different.
That's good, John. So on the topic of COVID, though, John, are you working from home? How has your work life changed as far as this current environment we're in with the pandemic?
I am working. I'm actually not working from home today. I went into the office today. So we can go into the office at any time. Most people choose to stay at home. So very few people are in here. There may be 5 people, I think, at work today. But I came in yesterday and today, because my house is getting painted and it's people banging on we're fixing some things around there. So I came in to the office. The work from home has gone extremely well. It's gone much better than I think the industry thought it would. The technology has held up very well, and the mechanics of what we do, we've been able to execute from home. We've been able to settle trades. We've been able to buy bonds. We've been able to talk to each other, have meetings over Zoom. We have our department meetings every Monday and Wednesday and Friday. We have these, formal meetings that we've always done, that we used to do face to face. Now we just do them on Zoom. We have, we all use Bloomberg. We have, the instant messaging on Bloomberg. So we're constantly in touch with each other on a day-to-day basis. So it has worked pretty well. But I will say, any job you have that depends on corporate thinking, and in my job depends a lot on it. It depends on other people's opinions. I need to know, first of all, it's not just me. I say I have two other portfolio managers in our department that work with me. And I want to be in constant contact with them, with our traders, and with our credit analysts to be able to put all our heads together in a fluid decision-making process. And I do think one of the problems with COVID, one of the problems it's introduced, while the mechanics of what we do have gone extremely smoothly, I think the decision-making process has been hurt in subtle ways. I do think you make much better decisions as a group than you do on your own. And I do think, it's been 6 months now, or I think we're in our 7th month of being from home. That's going to show up in subtle ways. So I'm looking forward to when we can all come back. We try to, you try to make up for that, but I'm not gonna make a phone call every time I have a question about one. Like, I'm sitting at my desk here, I'm looking out on our trading desk. Okay, I can physically see about 12 people. We only have 14 people in my department, so I can usually see at any one time 10 of them, and all 14 can hear my voice. So if we're bidding on something, and I just want to say from my desk, like, what did we do with that last time? Where did Chicago O'Hare Airports trade 6 months ago? Why, where are we today? Why didn't we like that? Somebody remind me of that, or the traders will jump on and go, well, the person who's selling the bonds, it's too rich. I'm going to bid them back. And the credit analyst may come in and say, well, be careful. It's some of the data that I've gotten in the last 6 months or 3 months has actually been a little bit worse than I thought. But they don't know to say that until they hear us asking questions about that. And so you can imagine if everybody's at home, it's like, well, I'm not going to answer a question unless somebody asks. I'm not going to answer anything unless somebody asks. No one's asking. Somebody may be curious about something, but I'm not so curious that I'm going to pick up the phone and call somebody. Do you know what I mean? So you lose that corporate thinking that I think is just so valuable. And you can get it when you're on Zoom, but you'd have to be on Zoom all the time to replicate what we used to have. And that's definitely one of the things I find the most troubling about the work from home environment.
Yeah, I'm just curious, John. Has this environment changed the way you and your firm have recruited, say, maybe people out of college or out of graduate school?
Well, we don't hire a lot of people right out of college, but we have hired people in this. So we've hired a new taxable bond analyst. Yeah, we've probably hired four or five people during this pandemic. So yeah, I mean, it's changed. The thing is, when you're interviewing, it's usually a face-to-face conversation when you're interviewing. And I think over Zoom, you can replicate that pretty well. In one interview we had, the guy's video didn't work. His audio worked, but his video didn't work. And he tried it a couple of times, it didn't work. And but whatever, we just kept going with just an audio, and we didn't hire him. We hired somebody else. Now, did that hurt him? Probably not, but it didn't help him, that's for sure. So, but in general, I would say that when you interview somebody face to face, you can pretty much do it over Zoom, and then usually when that's done, everybody has to debrief about the candidates and talk about the pros and cons. That's also sort of a formal process. We would normally go into a conference room, but you can do that over Zoom. So that actually has gone fairly well. Any sort of formal process is going to do fine from home versus here. And any person who is like that works at a job where they don't really need to interact with a lot of people, that goes really well as well. It's much more the problems that I found with the work from home has just been when you need a lot of people to weigh in on the same issue. A lot of the times, not just for a 20-minute conversation, but over basically through the entire day.
Yeah, yeah. Okay. John, we have a number of questions coming in. Can you stay with us for another 10 or 15 minutes?
Absolutely.
Great. So Cameron is asking about where your clients are. So your clients, you mentioned, are predominantly people that have extra money and they want to earn a rate of return on that money. And they've
Correct.
chosen your market, the municipal bond market, which is not one we've talked a whole lot about in class yet, but we know a little bit about it. So where are your clients? Are they Boston based, or are they all over the country, maybe the world?
So that's a good question. They're not all over the world, although on our equity sides they are. But in the municipal bond, for our municipal bond clients, only U.S. citizens would really get a benefit from owning municipal bonds because they are exempt from taxes. So that's the point of owning them. So they tend to be in the U.S., but they are all over the country. When I joined the firm, I was the 24th person hired. We had about 300 million in assets under management, and we had about 300 clients, and they each had a 3-digit number associated with them. And I knew, let's just say, I knew most of them. I knew, like, if you told me the name, I could tell you what their account number was because we were dealing with them so much. I was, in and out of these accounts so much. But you really can't scale a business doing that, a firm like ours, because how do you find these clients? What we did was we partnered with firms whose job it is to gather assets. So for instance, our largest client right now is not an individual client, it's Merrill Lynch. So Merrill Lynch, what Merrill Lynch found in the 1990s was they didn't want to keep giving advice to clients. They didn't want to give financial advice to clients on bonds. They didn't know how to do it. They didn't really understand the market. So what they did was they actually went on the other side of the table. So they went on the same side of the table as the client. They said, okay, we're really good at gathering assets. Together, client, you and I, we're going to go pick a bond manager. And we have this firm in Boston that all they do is municipal bonds at the time. And so we've partnered with them to where they'll manage your portfolio. And so what happens is we have a fee sharing arrangement. Merrill Lynch gets a portion of the fee that we get to manage those bonds, and we get a portion of it. But we don't have to go find the clients. Merrill Lynch goes and finds the clients. So it actually worked really well in that Merrill is really good at gathering assets and figuring out who has extra money and who wants to invest. They go to Merrill Lynch. They don't come to GW&K. But Merrill Lynch is not very good at actually investing that money. And they turn to us and say, okay, we have all these clients, we have all this money. We're going to put it with you guys. And so that's how we really grew our business. That's how we went from 300 million to 33 billion in munis over the last 30 years. We've worked with third-party companies like Merrill Lynch and other consultants that find these clients for us. We also have people that come to us direct, but it's a much smaller part of what we do.
Yeah, and John, just for the benefit of the students, so Merrill Lynch is a big financial institution, part of an even bigger one, and we would think of it as an investment bank. But also, we've distinguished between that type of company and a commercial bank here in the class, and those lines are getting a little bit blurry. But that's an old school investment bank. Is that
correct?
How you think about them?
Exactly. I still call them Merrill, but of course they're Bank of America, Merrill Lynch. They've kept the Merrill, they've kept that branding Merrill Lynch. But yes, it's Bank of America, Merrill Lynch, and they do so much. But this is one of the things that they do, and they do extremely well.
Yeah, we've touched on that a little bit. I think Tristan had a question. Do you have it?
It's a bond focused question. So
bond.
the types of bonds you mentioned, which ones are your company aiming to acquire through the trader?
Okay, of the bonds we mentioned, what was the last?
Yeah, which bonds are you aiming to acquire through your traders?
Okay, so I looking to do municipal bonds. But other, we do treasury bonds, we do mortgage backs, we do corporate bonds as well. But for the most part, I'm looking to buy municipal bonds, and that's issued by states, cities and towns, water and sewer authorities, universities issue municipal bonds, hospitals issue municipal bonds, the transit authorities issue municipal bonds. Anybody that has a quasi-public purpose or a 501c3 like universities and hospitals can borrow in the municipal bond marketplace. And those are that's the universe that I'm looking at buying for our clients.
Yep. And John, you mentioned it, but there's other types of ways that companies or governments raise money. We've talked a little bit about the U.S. Treasury market in particular. So that's our U.S. government going out and raising money. And cities and states do the same thing. And so do companies on the sort of bond side of the world. So let me just expand on that question. We've spent a lot of time, everybody could tell you here, on the U.S. Treasury market. And we'll go into a little bit of a geek out session of the presentation. And then we study that yield. We look at that 10-year note in particular and the yield that is generated from the way that bond trades. So back me up. Tell me that the students how important it is to at least understand a little bit about that U.S. Treasury market.
The U.S. Treasury market is the most important market in the financial world. The bond market rules the world. The stock market, by comparison to the bond market, is nothing. And even the muni bond market compared to the Treasury market is nothing. The Treasury market is the most important market in the world, has been for a long time. It's one of the reasons the U.S. enjoys the power it does across the world, okay? But the Treasury market, first of all, it's huge. It's a huge market. It's, for marketable debt that actually trades is about 20 billion. But it's a risk. It's the risk-free rate. So it's the borrowing rate that you borrow without taking on any credit risk, right? That's its benefit. And because of that, it's used to price all different kinds of securities. It prices, just think about like your own, if you took out a mortgage to buy your house, eventually you'll be doing that. That is the mortgage rates come right off the 10-year Treasury rate. But the bonds that we buy, municipal bonds, all priced off of treasuries, corporate bonds, auto loans, student loans, credit card debt, all of that comes from the Treasury market. It's a proxy for investor confidence. If interest rates are rising, typically it means that there's a lot more confidence in the economy. If rates are coming down, we think of treasuries as a safe haven yield. That's what we call it, safe haven. So when things are really doing poor in the world, like when COVID hit, everybody rushed. They said, I don't want to own stocks anymore because they might get killed. Let's go buy treasuries. And then the yield that pushes down the yield on treasuries. So when interest rates are when the yield on treasuries are going down, it's sort of a reflection that, wow, the people are losing confidence in the economy. It's also a proxy for inflation. If interest rates are rising, people think inflation. If the Federal Reserve is going to look to the yield on the Treasury market to give it some sort of signal to what the marketplace is thinking about where inflation is going. And the other thing that treasuries are great for, they're collateral for overnight loans. So yeah, okay. So the market, the Treasury market is, like I said, about 20 billion for marketable debt. It's about 26 billion total. And you compare that to the equity market, which is about 35 trillion. So 35 trillion versus 25 trillion. One's bigger than the other. But if you look at the daily trading volume in stocks, it's about 6 billion a day. If you look at the entire, U.S. equity markets. In treasuries, it's 500 billion a day. 500 billion. It is the oil it greases the entire market. And a lot of that is these overnight loans and collateral that banks need. You have to have access to liquidity. Think about when COVID hit, right? The stock market was getting killed. You know, if you're following it, you can see stocks going down 2%, another 2%, 5%, 10%. But it really wasn't that big a deal. The price of stocks it's fine, but it's in and of itself, it's not gonna cause any problems. If you don't have access to liquidity, if you can't borrow from one day to the next, you're gonna have a lot of trouble. And if you don't have collateral through which to borrow, and for the most part, the collaterals that most banks and companies use is US Treasuries. So it's extremely important for just the entire architecture of the investing world. So it permeates everything. I mean, we're not going to go. I'm not sure it's that intuitive for most people, but know that it touches everything you do. And you know, if you'd like to learn more about it, you know, a career in the bond market is fascinating, and just learning all those things to me is fascinating. So yeah, the Treasury market is a monster, and it basically is the underpinning of the entire financial markets.
Yeah, John, just so for the benefit of the students, you've used the term credit risk a number of times. That means the risk that you don't get paid back, right, by the government or a company or me. If you borrowed money from me, the risk would indeed be high.
Right.
Also, so John, was it worth it? We spent a lot of time breaking down the Treasury market from the headline number, 26 trillion, and we looked at how much the public owns and how much is intra-government, and even down to the Fed and the foreign countries. Was that worth it for this class to have that stuff?
Absolutely. I think everybody should have a knowledge of what's going on in the Treasury market, and knowing and knowing its impact, or even just understanding the scope of it, you know, because some of that money, yeah, that 6 trillion that they is not held by the government, that's not held by the public. That's not really debt. When you owe yourself money, that's not really a debt, you know. And the fact that the Federal Reserve owns 4 trillion of the outstanding US treasuries, you know, that's also part of our government. And, you know, we haven't been faced with it yet, but we may be faced with a time in the future where the Federal Reserve says, you know, what if we just extinguished this debt? What would happen if we just said, you know what, the Treasury doesn't need to pay us back because we're part of the government anyway. Like we don't need to own that. What would that mean? Under what circumstances would it even occur? And how would it reverberate across the markets and into Main Street, not just Wall Street? And it would. So it's good to know these things, you know, that Japan and China own 2 trillion of our debt. What does that mean? What kind of pressures does that put on us? Do we have to worry about them selling our treasuries in the marketplace and driving up interest rates and causing havoc into the world? You know, you should know that. You should think about that, and know also. Don't worry, they're not going to do that because it's in their best interest to own those treasuries. They like having treasuries as much as we like lending it to them. I mean, U.S. Treasuries is one of the greatest exports the U.S. government has, and it provides a lot of stability for our way of life. The fact that people want to own it. So, you know, I think there's about 4 trillion in foreign holdings of U.S. Treasuries. I think that's right. If it's not, it's close.
We have a little higher number, but we'll send you the full breakdown of our mathematics.
You're probably right.
Yeah, let's continue the commercial for my course material here. I heard you mention that there was a lot of buying of the U.S. Treasury through the pandemic. What did that do to the yield, and how did your market react to that period of time? I remember a lot of people were selling municipals. So what's that do to yields, and And is that something that everybody knows? I mean, I've introduced that topic to the students. I'm just trying to impress upon them. There's a lot of, graduate school level people in the world that don't know that, but help us understand it.
Well, that's for sure. I mean, I think T. Rowe Price did a survey, and they found that 8% of people understood that when prices of a bond go up, the yield goes down. Most people think it goes in tandem. So very few people understand bonds. When I got into the bond market, one of the reasons I did so well in this market was that nobody understood it. It was a great education for me. I was so fascinated. Here I am, 23, 24 years old, and I'm talking to people who are even on the stock side of finance that have no idea how a bond works. And so it was such a great opportunity for me to move up. So it's not intuitive. It's not intuitive at all. But so going back to when COVID hits and people want to own treasuries, bonds is just like anything else. It's just they get priced off supply and demand. So if there's a huge demand for it, their price is going to go up. Price of anything goes up when there's a huge demand for it. If you hold supply constant, right? That's just basic economics. But the price goes up, the yield goes down. And so treasury yields plummeted during COVID because everybody wanted to own them. And they were selling anything that wasn't a treasury, including municipal bonds. Typically, when treasury yields go down, municipal yields go down in tandem. We usually follow exactly what the treasury yield does. So if you told me what the treasury yield did on a day, I can pretty much tell you what happened with municipal bonds on a day. But that was not the case in COVID. In COVID, everybody was selling municipal bonds, and the price of municipal bonds was going down, and our yields were spiking. And it was, for a 2-week period in March, it was terrifying. Honestly, it was terrifying because there was no liquidity in the marketplace. And what I mean by that is when people want to sell, there was nobody to step in and say, I'll buy it from you, right? Because you can't sell unless somebody buys it. In the municipal bond market, it's an over-the-counter market. It's not like the stock market where you just go in, where there's a central exchange, the New York Stock Exchange, where buyers and sellers come together. In the bond market, I got to pick up the phone and say, okay, we have 20 million bonds out for a bid. Somebody give me a bid. And if nobody gives me a bid, I can't sell it. And so I have to drop the price. Okay, what if I, let's just think of it in terms of dollar price. If you tried to sell it at par, that's where I think it's worth. Okay, no one wants to buy it at par. Par being 100 cents on the dollar. Okay, how about 95 cents on the dollar? Would anybody want to buy it then? Nope. 90 cents on the dollar. Does anyone? And so you see these big air pockets where the price of our bonds were dropping so low, and it's because people were very scared. They thought this, everybody working from home and businesses shutting down. How can anybody pay you back? The only one that was guaranteed to pay you back was the U.S. Treasury, and that's why everybody flocked to the U.S. Treasury. And it wasn't until the Federal Reserve came in and Congress came in and said that they would help backstop municipals. They also want to help backstop corporate bonds, that the market stabilized and prices came back and yields dropped back down again. But for a couple of weeks there, it was touch and go. Much worse, I will say, much worse than the financial crisis, 2008, 2009, when Lehman went bankrupt. That was also scary at that time. That was much scarier than, say, 9/11, which was also another problem in 2001. We had problems with the markets. It was worse than the financial crisis in 08, 09, and it was much, much worse this past March. The big difference between now, March of 20, and what happened in the financial crisis was Congress stepped up and passed that CARES package, a $3 billion aid package, much, much quicker than back in the financial crisis. It took them, in fact, Congress voted down the TARP, which was I think at the time, like a $600 billion aid package, and that made the market go haywire. And it took a while for that to happen. This time, the government stepped up much quicker.
Yeah. John, we just have a couple minutes left in our class here, and really want to thank you for staying with us for this period of time. I've got one question to clean up that I didn't, from a student, Mariko, who I didn't see in time, but are there any skills that you haven't mentioned that a portfolio manager really should have and use? You've mentioned a couple of them, but if you have just in a couple seconds, if you hadn't mentioned one already, I'll just address that question.
So like I said, as far as like hard skills go, it's math and English, you know, your ability to write, your ability to communicate clearly. But, you know, so many people have those skills. Pretty much everybody has those skills, you know, to the level you need to be a portfolio manager or to succeed in our business. Like you definitely need a minimum skill level, but because that skill level is not very high, I'm assuming most of you people already have it. It's much more the soft skills, being able to work with other people, openly communicating, and helping other people out. That's gonna get you a lot farther than any sort of hard skill. Learning our lingo, easy enough. Just takes a while.
Any other questions for me, Kenzie, for anybody? Let me ask you one final one, John. You're a Wall Street hotshot now. I assume you grew up, you work in a big city, you know, shuttle between New York and Boston a lot. I assume you grew up with like a really rich family and took limousines to grade school and so forth. Is that right?
No, that is not correct. I grew up in Rhode Island. So my parents were immigrants. So I had no background in this. My parents have no background in this whatsoever. They had 6th grade educations, so they were no help.
Yeah. So any reason these students from Midway University can't be the next John Fox?
Oh gosh, no. In fact, I'm sure they will be. I'm humbled to be in front of the group, and I feel like my time is. I'm on the wane. I'm going to be working for these guys soon enough. I want them to treat me well.
Well,
when they do.
This will help. We have a tradition in the class. I don't know if you can see me, John, but we have a Midway University hat for you.
Okay.
And you may know our mascot here is also the Eagles.
Yes, go Eagles.
Always about Boston College, also the Eagles. So you are now an honorary Midway University Eagle, and we all really wanted to thank you very much, John. Thanks for being with us.
Awesome. Go Eagles.